Hi, everybody. Welcome to the Off Market with Adam Stern. We got an interesting show today. We've got a guest, Jamie Nahon from Eagle Opportunity Zone. And it's about a subject, as you might guess, opportunity zones, that I think a lot of people have heard about, but not a lot of people know well, and certainly not a lot of people know it as well as Jamie does. I've known Jamie for a long time. He used to be an SFR portfolio owner in Florida. He sold his portfolio, opened up Eagle Opportunity Zone to, well, I'll let him explain it. So Jamie, give everyone kind of like high-level overview of like your background, what you did before this, how you landed in the Opportunity Zone segment. You want to give everyone kind of a breadth of experience in your background?
Sure. I am a CFA. I worked for 10 years in Canada for the largest retail developer over there called Smart REIT. And I watched the owner of that company make billions of dollars. In 2012, I went off on my own and raised some money, went down to Florida, bought a bunch of houses and buildings, held them till 2017, sold them, made a bunch of money, and took my investors' money to Chicago, which is a pretty unique market, much more like Toronto, where I'm from originally. One of the things that I love about Chicago, it's the nation's third largest metro, but property values lag behind the two larger contenders by at least 50%, New York and LA. So there's a huge opportunity for real estate appreciation there as Chicago grows. It's a very deep market with a lot of opportunity. I found myself doing business just south of the downtown, including in the south side, which gets a lot of headlines. And it's definitely a market that you need to know what you're doing in. And I started getting into new construction of 3-unit apartment buildings in a little neighborhood just south of downtown, not the south side. It's called Bronzeville, which is a stone's throw from McCormick Place and a 10-minute subway ride into downtown. And we discovered that we were in something called an opportunity zone. And so we started researching what this opportunity zone is, which was announced with the 2017 Tax Cuts and Job Act and was finally legislated in 2019. And now widely believed to be the greatest tax incentive of all time.
You said a few interesting things there. You started with why you picked Chicago. Any good real estate investor, no matter what the real estate investment vehicle is, or no matter what kind of strategy you're pursuing on that real estate investment, picking a market is above all else, I think, the most important thing. You told us about why you picked Chicago. Now you're going into the strategy of opportunity zones. I think that's a great place to start. We see a lot of investors investing in places because of the assets or because of the yields, but really understanding where you're investing and what the demographics and economic potential of that area is a super interesting and really well-proven, well-tested place to start. So before you get into opportunity zones, I wanted to make note of that because you're not new to this. You've actually picked markets before, like before you picked the market in Florida, you invested in single-family real estate, and then when you saw the opportunity shifting, you sold, and then you got out, and then you picked another market with a different strategy. That about sum it up?
Yes, it does.
Yep. So for those of our audience that don't really understand what an opportunity zone is, before you start going into specifics about Chicago and this area of Chicago that you have the strategy in, you want to give people a high level on what an opportunity zone is?
Sure. So something like 12% of all land in America is now an opportunity zone. And opportunity zones were designated following this new legislation by the states, by selecting census tracts that had below average income, certain measures and metrics of poverty, with the intent to direct private capital into these neighborhoods, into these census tracts. And the government has offered what the people who know what an opportunity zone is to be the greatest tax incentive of all time. So if you can figure out how to set up an opportunity zone fund and you find a piece of real estate, it doesn't only have to be a real estate investment. It can also be a business investment in one of these opportunity zones.
So basically the government figured out how to get private capital to kind of plow into areas that need economic revitalization, right? And then they created this opportunity zone program to incentivize people with tax incentives to go and spend their money and invest their money in certain areas that can use that boost. You started talking about, the greatest tax incentive of all time. I'm not a tax attorney. I'm an accountant. I know the benefit of tax incentives, but you want to give people a sense of the explanation of what that tax incentive exactly is?
Sure. So if you have capital gains, you have to pay tax on those capital gains. If you invest your capital gains in an opportunity zone, the first incentive is you don't pay your capital gains tax until 2027. So it's a deferral now for 5 years. If you hold your opportunity zone investment, your new investment, for 10 plus years, there is 100% step up in basis when you sell, which means there is zero capital gains tax on your new investment in an opportunity zone. And that's not only on the capital gains, that's also on the recapture. So you pay zero tax on your capital gain and on the depreciation recapture in 10 plus years.
So basically, the government created a new program that's kind of like in competition, and correct me if I'm wrong, kind of in competition with 1031 exchanges, where a lot of people that know 1031 exchanges use it as a tax deferral mechanism that they don't pay the taxes until they actually get out of the next property. And they essentially have to die and pass their property along to their heirs in order for that tax to be wiped out, where the heirs that inherit that property, get it inherited at the current basis. So basically, this is just another tax deferral strategy besides a 1031 exchange, right?
There are some similarities with the 1031. Some of the big differences is with the 1031, you have to reinvest everything. With an opportunity zone, you just have to reinvest the gains a portion, not the principal of your prior investment. In order to get the benefit, you have to hold the investment for 10 plus years. You also have to double your basis. So you can't just buy a building in an opportunity zone and cash flow it and get those incentives. You actually have to reinvest money or put more money into the deal.
So for a layperson like me, if I invest $1 million of my profit that I made off of the sale of a piece of real estate, let's say, I can't just invest that money, the $1 million, into a cash flowing piece of real estate. I got to take another $1 million out of my pocket and invest $2 million, my gains plus new money, to get the benefit. Is that right?
Two things to fix what you just said. Number one, your gains don't have to be from real estate, which is another difference with a 1031. You could have been holding cryptocurrency and sold it for a profit. You could have sold your business and have a huge capital gain. And your second $1 million, which you said you're taking out of your pocket, it doesn't have to be from your pocket. It can be included in that gain. So the reinvestment of your gains doesn't just have to be for the purchase of the property. Those gains can also be included in the doubling of your basis.
Yeah, so now we've explained what the opportunity zone is, right? Let's talk about the investment, the strategy that your opportunity zone fund is making in Chicago. You want to kind of give us a high level on the investment, why you're doing it, why this particular area, kind of the nuts and bolts of the actual investment fund strategy in Chicago?
Sure. Let me just clarify a couple of things, though, Adam. To invest in an opportunity zone, you could create your own opportunity zone fund and go off and do it on your own, where there is a lot of compliance and a lot of work to figure out how to do that. Or you could invest in an opportunity zone fund, which is what most people who have capital gains who know about this are doing. And you leave it to the fund manager to figure out how to double your basis, how to abide by all the rules and compliance. So that's an important factor.
Right.
Another bit of math that I've done, which I think is very interesting for somebody who is new to opportunity zones, is if you're looking at a piece of real estate or a project and you assume that in 10 years, this project is going to triple in value, which you would hope for with any good real estate investment that you're holding for 10 years. The opportunity zone incentives are worth 50 cents on the dollar in present value terms.
Okay.
So if we take all of the various incentives that come with the opportunity zone, including such things as reinvesting your capital gains tax until 2027, including bringing the tax exemption or the 100% step up back to present value, and you look at all of that, you're making 50 cents in present value terms at a 6% discount rate just by investing your dollars, your capital gains in an opportunity zone versus not in an opportunity zone fund.
Right.
Which is some pretty amazing math.
Is it fair to say that if you went head to head with a sponsors like a professional real estate investment firm that invests in real estate for other people, if you went head to head with a sponsor in two very similar kinds of real estate, you could actually do worse in terms of your overall return on your opportunity investment and still kind of come out ahead? Does the math work out that way?
For sure. I mean, we measure IRR with and without the opportunity zone incentives. And my deal, the IRR, which is a 10-year IRR, is 17% without the incentives and 20% with the incentives.
Okay.
And most of those incentives come in 10 plus years. So we all know that an IRR is bringing money back into present value.
Right. I sold way back when I was in my late 20s, things called tenant in common investments and DSTs, Delaware Statutory Trusts, which were vehicles for 1031 exchange investors. And one of the main worries of a private investor investing in a sponsor is like sponsor background, regulations that protect them against getting scammed or ripped off. In this opportunity zone segment, are the same kind of protections in place? Does the government regulate this highly? Are there as many protections as there would be investing in the stock market or through 1031 exchange intermediaries?
No, it's treated like any other sponsor as far as, the protection for the investor. My fund is a Reg D SEC offering. So the investor is protected by all the various elements in our PPM and by the SEC.
Okay.
And then investors, like they would with any other type of investment, have to do their own diligence and get comfortable that the fund manager is going to abide by the compliance of the opportunity zone. The government is not forcing somebody who represents themselves as an opportunity zone fund manager to be in compliance. So one of the things that people like I do is we engage a fund manager, a third party, a fund administrator, who is an expert in opportunity zone compliance. And that is made as a representation up front in our PPM. And so the investors know that there is a third party who is verifying the opportunity zone compliance throughout the 10-year hold.
Got it. So basically, there's a lot of protections in place. Government puts the same protections or similar protections as any other kind of like regulated segment of the investment world, but it's still real estate. It still comes with risk. It's still buyer beware. You got to do your due diligence and make sure that your sponsor, the guy that's actually making the investment, is doing all his due diligence, has a good strategy, is buying the right kind of real estate at the right time at the right price. Is that right?
Not only that, but you're investing for a 10-year hold. So you better make sure that you're comfortable with your manager because you're going to be with him for 10 years. And most real estate funds and projects are 5 years or less. This is 10 years. And so when you're looking at an IRR that is based on exit assumptions in 10 plus years, you should make sure that you're comfortable with the rent growth assumptions, with where the sponsor has projected the exit numbers, because no one knows what the world is going to be like in 10 years. Which kind of brings me into the answer to the question you asked me earlier, why we're doing what we're doing in the market that we're doing it. When you're locking your money up for 10 years in an opportunity zone, which is generally a more challenged market than not an opportunity zone, you want to see catalysts. You want to see an investment thesis that shows there's going to be economic growth in this neighborhood, in this market, that will warrant pretty strong rent growth assumptions, cap rate compression, even in a market where there's, higher interest rates, so that you see a nice profit number in 10 years, because you're discounting those profits to your present value time in order to see your IRR.
Yep. So it's interesting. You got to contend with a long-term view of whatever real estate you're investing in. But you don't have a crystal ball. For a market like Chicago that's had its troubles, everyone knows that's been paying attention, knows that Chicago's had its troubles. Do you see that as part of the opportunity? Do you see that as one of the major long-term risks? Maybe a little bit of both? How do you reconcile going into a market that has issues today, but I'm assuming, according to your view, it's got good places to go. It's got opportunity, and it's going to grow, and it's going to get better there.
For sure. I mean, everybody hears the headlines of crime in Chicago, weekend shootings, which is so sad and so scary. Mm-hmm. And, we happen to be doing business in a neighborhood where that doesn't happen. Mm-hmm. And I can give you a little bit of the economics of the neighborhood. We're building 3-unit multifamily apartment buildings on scattered infill sites in well-established residential neighborhoods.
And when you say scattered infill sites, just make sure everyone understands. So basically, it's not one contiguous parcel. You're looking for scattered parcels throughout this area to build your properties on.
Right. So if you go to the blocks where we have buildings, you'll see our new buildings there, mm-hmm. and you'll see other new buildings built by other developers on the same blocks, and you'll see older buildings that have been there for 100 years. Mm-hmm. And generally the lots that we're building on used to have a building that was taken down 20, 30, 40 years ago, and it's a vacant lot. Mm-hmm. And so everything is entitled for what we're doing. So everything is zoned for residential.
Just so people understand what entitlement means. Entitlement kind of refers to the process of getting all the paperwork done so that you can pull permits and actually build buildings. So entitlement starts with making sure the zoning is correct, meaning, areas that are zoned for a particular kind of real estate, that real estate can be built there, or if it's not zoned for that kind of real estate, you need to get it rezoned. And other things, including submitting a site plan, getting that approved, or any other requirements by the municipality before you actually can get issued a permit to start pushing around dirt and building buildings. So do you take your property from lot, which is already entitled? Do you look for already entitled lots? Or do you actually develop the lots into fully entitled lots and then start building your real estate?
In general, we're buying lots that have residential zoning for what were the intended building, which is a 3-unit apartment building.
Yeah, I'm looking at this as one real estate investment, but it's really a bunch of sporadic or scattered lots that you're building a product type on. Is all the product the same? Is it going to be under the same management company? Are there nuances to what you're building based upon the neighborhoods in which you're building them?
Right. So if you look at opportunity zone tracts, there are certain neighborhoods like the south side of Chicago, probably, a ton of farmland across the entire country. The whole thing is an opportunity zone.
Yeah.
So anywhere that you would go in those neighborhoods, you're building in an opportunity zone. Mm. Our neighborhood, which is Chicago's historic Bronzeville, only certain blocks are in an opportunity zone. Other blocks are not in an opportunity zone, right, because revitalization is already happening. It's already underway. Condos like we're building, they're being built to condo grade, which we're going to rent, are currently selling for $350,000 a unit, which if you went into other opportunity zone neighborhoods, you couldn't sell condos for $100,000 a unit. This neighborhood, the market rents for the 3-bed, 2-bath units with enclosed parking that we're building are in the $2,500 range for new build space. So that justifies the cost of new construction in this opportunity zone. Right. If I was to go 5 miles south of where I am, or even 3 miles south of where I am, I could not afford to build these buildings because the value isn't there. I couldn't get financing. I couldn't get the rents. Right. And so, what's happening in this little submarket of Bronzeville, We're very close to Obama's new presidential center, just southeast of us in Hyde Park, which is creating 7,500 new jobs. Construction started this past summer. It's a $700 million project, which is really bringing a lot of excitement into the neighborhood. But the major catalyst that we have in Bronzeville is the redevelopment of a big old hospital right in Bronzeville, which is known as the Bronzeville Lakefront Project, which is supposed to start construction within the next 6 months, which is a 8 million square feet mixed use space that's going to cost over $3 billion, that is forecasted to create 48,000 new jobs.
That's like a city block. That's like more than one city block, that much square footage.
If you live in Chicago, you know about it. If you Google City of Chicago, Bronzeville Lakefront, you'll see their website where they're tracking all the approvals and where you can see all kinds of beautiful visuals that show what is going to be happening there. So that is in our neighborhood. That hasn't started yet. We already have revitalization happening here, which is very much like the neighboring Hyde Park, home to President Obama, to the immediate southeast where the Obama Presidential Center is going. This is spilling now into Bronzeville. And so it's very exciting for anybody who's investing there. And we have found these little lots of land on the Opportunity Zone blocks. So some of these blocks are not in the Opportunity Zone. You don't see big developers in this neighborhood because there are no large pieces of land where you can build, a 100-unit apartment building. The only way to get exposure into these Opportunity Zone blocks is really by doing what we're doing. And so, our strategy to assemble many infill parcels allows us to achieve scale and create an institutional style Opportunity Zone investment that gives people with capital gains the ability to get exposure into this market.
So it sounds like you've identified this niche for yourself, and it's a good opportunity for you because not only do you understand Opportunity Zones and all the things that go along with it, you understand land development and building, and you don't have to compete with the big institutions because the plots of land that you're buying are just too small for them to go after. So, if a person wanted to do what you're doing, they'd have to get really, really smart on not only Opportunity Zones, know how to develop land, but also how to build properties. And that's not an easy thing to do, along with, obviously knowing everything there is to know about Opportunity Zones. So congratulations on the launch of the fund. How long has the fund been in operation for?
So our Fund 1, which is coming to a close, we launched in January of this year. We've owned the land for that fund since 2019. We got slowed down by COVID in terms of construction finance. We are now under construction with the first 11 buildings, which will be done by spring. You can see some beautiful photos here, and you can see some of the other new build property on the block. We have some great video that shows that. And we've just launched a second fund to build another 66 of these 3-unit apartment buildings.
Got it. So Fund 1's almost closed, launching a new fund. Jamie, I can't tell you how interesting this has been. I didn't know half as much as I know now about Opportunity Zones. So just for people that are interested in your fund, that are interested in learning more about Opportunity Zones, you want to let people know where to find you?
Sure. Go to our website, eagleoz.com. There's a calculator there which you can download where you can plug in your capital gain number and you can see how much money you're going to save in taxes. And there's a whole bunch of information and resources there. You can also download our investment summary, and you can email me at info@eagleoz.com if you want more information about Opportunity Zones in general, or if you're interested in investing your capital gains with us. We show a 20% 10-year IRR. We pay out 6% in a preferred distribution. and we have a 9% IRR hurdle, so we don't take our cut of the profit until you get 9% on your IRR. And there are many opportunity zone funds out there. If you start looking, you'll come across a lot of them. Some of them are great. You have to be very careful with those 10-year assumptions that you are really betting on where the market is going to be in 10 years, and you're betting on the manager that they will be able to look after your investment for those 10 years.
Jamie Nahon, Eagle Opportunity Zone. Appreciate you being with us.
Thanks, Adam.
Thanks a lot for watching. If you want to subscribe, we're on all the major podcast channels or YouTube. Click to subscribe. Hope you follow us. Thanks a lot.